And a handful of seniors who have been waiting for specific benefits are about to get news they have been praying for. The Social Security Administration does not always make it easy to understand what is happening. And that is exactly why I am here today, to cut through all the confusion, all the government jargon, and give you the straight truth in plain English. Because you have worked your entire life, you have paid into this system with every single paycheck, and you deserve to know exactly what you are entitled to receive. Now, the first thing you need to understand is that the start of February marks the beginning of a new era for Social Security recipients. The government has implemented what they are calling a comprehensive adjustment period, and it is based on inflation data, economic indicators, and changes to the cost of living that have been impacting every American's wallet. You felt it at the grocery store, at the gas pump, when you pay your utility bills. Everything costs more than it did a year ago, and the government knows this. That is why they have approved a cost of living adjustment, commonly known as COLA, that will increase monthly benefits for nearly everyone receiving Social Security. But here is where it gets interesting, and this is something most people do not realize. The increase is not the same for everyone, and depending on your specific situation, you might be eligible for additional adjustments that go beyond the standard COLA increase. If you are currently receiving Social Security retirement benefits, you are going to see an increase in your monthly payment, starting with the check you receive in February. The average retiree who is receiving around $1,700 per month is now looking at an increase that could push that amount to over $1,800. Now, I know what you are thinking. That might not sound like a fortune, but when you are on a fixed income, an extra $100 or more each month can be the difference between having to choose between medications and groceries or being able to afford both without worry. That is real money that affects your real life every single day. The exact amount of your increase depends on several factors. It depends on when you started collecting benefits. It depends on your lifetime earnings record, and it depends on whether you are receiving benefits based on your own work history or as a spouse or survivor. The Social Security Administration uses a complex formula to calculate these adjustments. But do not worry, you do not need to understand the mathematics behind it. What you need to know is this: your February payment is going to be higher, and you should receive a notice in the mail or through your online Social Security account that explains exactly how much your new monthly benefit will be. If you are currently receiving Social Security retirement benefits, you qualify automatically. You do not need to do anything. You do not need to file any paperwork. You do not need to call the Social Security Administration. The adjustment happens automatically, and your increased payment will show up in your bank account or in your mailbox, depending on how you receive your benefits. The same goes for people receiving disability benefits through Social Security disability insurance. Your payments are also going up. And again, it happens automatically without any action required on your part. There are additional changes taking place at the start of February that go beyond the standard cost of living adjustment. The Social Security Administration has updated the income limits for people who are receiving benefits but still working. Now, if you are someone who retired early and started collecting Social Security before reaching your full retirement age, but you have also continued to work part-time or even full-time, you need to listen very carefully to what I am about to tell you. The government has specific limits on how much you can earn before they start reducing your Social Security benefits. And these limits are changing now. If you are under your full retirement age for the entire year, you can now earn up to $23,400 without any reduction to your Social Security benefits. That is an increase from last year, which means you can earn more money from working without the government taking a portion of your Social Security check. But if you earn more than that threshold, the Social Security Administration will deduct $1 from your benefits for every $2 you earn above the limit. Now, I know that sounds complicated, so let me give you an example that makes it crystal clear. Let us say you are 64 years old. You are collecting early retirement benefits, and you are working part-time earning $28,000 this year. You have exceeded the limit by $4,600. That means the Social Security Administration will reduce your annual benefits by $2,300, which works out to about $192 per month. If you are reaching your full retirement age this year, there is a different, much more generous limit that applies. In the months before you reach your full retirement age, you can earn up to $62,160, and the reduction is less severe. For every $3 you earn above that limit, they will only deduct $1 from your benefits. And here is the best part. Once you reach your full retirement age, which is either 66 or 67, depending on the year you were born, all of these limits disappear completely. You can earn as much as you want without any reduction to your Social Security benefits whatsoever. The government will not touch a penny of your Social Security check, no matter how much money you make from working. Now, let us talk about something that affects millions of spouses and widows across this country, because the changes include important updates for people receiving benefits based on someone else's work record. If you are receiving spousal benefits, meaning you are getting Social Security based on your husband or wife's earnings history, your benefits are also increasing with the cost of living adjustment. The same automatic increase applies to you, and you will see that reflected in your February payment. But here is something many people do not realize, and it is absolutely crucial if you are in this situation. If your spouse passes away, you may be eligible to switch from spousal benefits to survivor benefits. And survivor benefits are typically higher because they are based on 100% of what your spouse was receiving rather than the 50% you get with spousal benefits. The rules for survivor benefits have been clarified and expanded, and starting now, the Social Security Administration is making it easier for widows and widowers to claim the benefits they deserve. If your spouse died and you are not currently receiving survivor benefits, you need to contact the Social Security Administration immediately. Do not assume that they will automatically switch you to the higher benefit amount. In many cases, you have to actively apply for survivor benefits. And I have heard heartbreaking stories of people who went years without claiming benefits they were entitled to simply because they did not know they needed to ask. The Supplemental Security Income program, known as SSI, is also receiving a cost of living adjustment. SSI is different from regular Social Security because it is a needs-based program for people with very limited income and resources. If you are receiving SSI, your monthly payment is also going up. The maximum federal benefit for an individual is increasing to $943 per month. And for couples, it is going up to $1,415. Now, I know those numbers might not sound like much, especially when you are trying to survive in today's economy, but every dollar counts when you are living on such a tight budget. The income and resource limits are also being adjusted. To qualify for SSI, you generally cannot have more than $2,000 in countable resources if you are single, or $3,000 if you are married. But not everything counts as a resource. Your home does not count. Your car does not count if you use it for transportation. Your personal belongings and household goods do not count. The government is looking at things like bank accounts, stocks, bonds, and other financial assets. And here is a change that is taking effect now. The Social Security Administration is making it easier for people to qualify by excluding certain resources that used to count against you. For example, if you are saving money for burial expenses, you can now set aside more money specifically for that purpose without it affecting your SSI eligibility. The changes also include adjustments to how much you pay into Social Security through payroll taxes. If you are still working, you have probably noticed that a portion of every paycheck goes to Social Security and Medicare. That is your FICA tax, and the amount you pay is based on your earnings. For this year, the maximum amount of earnings subject to Social Security tax is increasing to $174,900. What this means in practical terms is that if you earn less than that amount, you will pay Social Security tax on all of your wages. But if you earn more than that threshold, you will not pay Social Security tax on the amount above it. This is important because it affects how much you are contributing to your future benefits. And it also impacts how your future benefits will be calculated when you eventually retire. Let me tell you something that not enough people talk about, and it is one of the most valuable things you can do to maximize your Social Security benefits. The timing of when you claim benefits can make an enormous difference in how much money you receive over your lifetime. You can start claiming reduced retirement benefits as early as age 62, or you can wait until your full retirement age to receive your full benefit amount. But here's the secret that could be worth tens of thousands of dollars if you delay claiming benefits past your full retirement age. Your benefit amount increases by 8% for every year you wait up until age 70. That is an incredible return on investment that is guaranteed by the government. So, if your full retirement age is 67 and you wait until 70 to claim benefits, you will receive 32% more every single month for the rest of your life compared to what you would have gotten at full retirement age. If you need the money sooner, then you should absolutely claim it when you need it. But if you are in a position where you can afford to delay, where you are still working, or you have other sources of income, waiting could dramatically increase your lifetime benefits. And this becomes even more important when you consider survivor benefits. If you are married and you are the higher earner, waiting to claim benefits does not just increase your own payments. It also increases the survivor benefits your spouse will receive after you are gone. That is a legacy of financial security you can leave for the person you love most. Unfortunately, whenever there are changes to Social Security, scammers come out of the woodwork trying to take advantage of seniors. You might receive phone calls from people claiming to be from the Social Security Administration, telling you that your benefits are going to be cut off unless you provide personal information or pay a fee. I need you to understand this very clearly. The Social Security Administration will never call you and threaten to suspend your benefits. They will never ask you to pay anything to receive the cost of living adjustment. They will never demand that you provide your Social Security number or bank account information over the phone. If you receive a call like that, hang up immediately. It is a scam and you should report it. They will send you official letters through the mail. They will update your account information on their official website. And if you need to speak with someone, you can call their official phone number, which you can find on their website or on any official correspondence you have received from them. Do not trust caller ID because scammers can fake that. Do not click on links in emails claiming to be from Social Security because those are often phishing attempts designed to steal your information. Always go directly to the official website by typing the address into your browser. Now, let us talk about something that has been causing confusion for a lot of people, and that is the question of whether these benefit increases will affect other programs you might be enrolled in. If you are receiving Medicare, Medicaid, food stamps, or other government assistance, you are probably wondering if your increased Social Security payment will make you ineligible for those programs. The answer depends on the specific program and your individual circumstances. For Medicare, your increased Social Security benefits will not affect your eligibility because Medicare is available to everyone over 65 regardless of income. However, your Medicare Part B premium, which covers doctor visits and outpatient care, is typically deducted from your Social Security payment, and that premium does go up slightly each year. For this year, most people are paying around $174 per month for Part B. But if you are a higher income earner, you might pay more based on your tax returns from 2 years ago. For Medicaid and food stamps, which are needs-based programs, an increase in your Social Security income could potentially affect your eligibility. But most states have built-in protections to ensure that cost of living adjustments do not automatically disqualify people from these programs. The exact rules vary by state. So, if you are concerned about this, you should contact your local Medicaid office or Social Services Department to find out how the increase might affect your benefits. In most cases, the increase is modest enough that it will not push you over the income limits, especially because those limits are also adjusted for inflation in many states. The Social Security Administration has updated their online tools and calculators, and these resources can be incredibly valuable in helping you make informed decisions about when to retire and when to claim benefits. If you have not already done so, I strongly encourage you to create a My Social Security account on the official website. It is free, it is secure, and it gives you access to your complete earnings history, estimates of your future benefits, and the ability to manage your account online. You can see exactly how much you have paid into Social Security over your entire working life, and you can get personalized estimates of what your monthly benefit would be at different claiming ages. This information is gold when you are trying to plan your retirement, and it is available to you right now at your fingertips. Let us say you retired early and started collecting reduced Social Security benefits at age 62. You did this because you needed the income, or maybe because you were forced to retire due to health issues or job loss. But now you are 65 or 66, and you realize that claiming early significantly reduced your monthly benefit amount. Is there anything you can do about it? Well, here is some good news. If you are within the first 12 months of claiming benefits, you have the option to withdraw your application, repay all the benefits you have received, and then reapply later for a higher benefit amount. This is called a do-over. And while it requires you to pay back everything you have received, it essentially gives you a fresh start and allows you to increase your future monthly payments significantly. Once you reach your full retirement age, you can voluntarily suspend your benefits. During the suspension period, which can last up until age 70, you will not receive any monthly payments, but your benefit amount will increase by 8% per year. Then, when you restart your benefits, you will receive those higher payments for the rest of your life. This strategy makes the most sense for people who have other sources of income and do not absolutely need their Social Security checks during those years. It is a way to undo some of the penalty you incurred by claiming early. If you were married for at least 10 years before your divorce was finalized, you may be eligible to receive benefits based on your ex-spouse's earnings record, even if they have remarried. This is called divorce spousal benefits, and it is one of the most misunderstood aspects of Social Security. You can receive up to 50% of your ex-spouse's full retirement age benefit amount. And here is the amazing part. Claiming divorce spousal benefits does not reduce or affect your ex-spouse's benefits in any way. They will never even know you have applied for them. The Social Security Administration handles these claims completely separately. To qualify for divorce spousal benefits, you must meet certain requirements. You must have been married for at least 10 years. You must be currently unmarried. You must be at least 62 years old. And your ex-spouse must be entitled to receive Social Security retirement or disability benefits. Even if your ex-spouse has not actually applied for benefits yet, as long as they are eligible and you have been divorced for at least 2 years, you can still claim benefits based on their record. This is a huge benefit for people who sacrifice their own career advancement to support their spouse's career or to raise children during the marriage. The government recognizes that contribution, and these divorce spousal benefits are designed to ensure you are not left financially vulnerable because of a divorce. Here is something that will really grab your attention, and it is particularly relevant with the current changes. If you are receiving Social Security disability benefits and you are approaching retirement age, your disability benefits will automatically convert to retirement benefits when you reach your full retirement age. The amount stays the same, but the category changes. This is important because the rules and requirements are different for disability versus retirement benefits. Once your benefits convert to retirement benefits, you no longer need to prove that you are disabled, and you no longer need to worry about the Social Security Administration conducting disability reviews to determine if you are still eligible. Your benefits are locked in for life at that point. If you are receiving disability benefits and you try to return to work, there are special rules that protect you during that transition period. The Social Security Administration has what they call a trial work period that allows you to test your ability to work without immediately losing your disability benefits. You can work and earn money for up to 9 months, not necessarily consecutive, while still receiving your full disability payment. After the trial work period ends, there is an extended period of eligibility that lasts for 36 months, during which you can still receive benefits for any month that your earnings fall below a certain threshold. These protections are designed to encourage people with disabilities to try working again without the fear of losing their safety net if things do not work out. Let me share something with you that could affect your taxes because this is an aspect of Social Security that catches many people off guard. Depending on your total income, you may have to pay federal income tax on a portion of your Social Security benefits. Now, this does not mean you are being taxed twice on the same money, because you did not pay income tax on your employer's portion of the Social Security contributions when you were working. But it does mean that if you have other sources of income in retirement, such as a pension, retirement account withdrawals, or investment income, you might owe taxes on up to 85% of your Social Security benefits. Here is how the IRS determines whether your benefits are taxable. They use something called combined income, which is your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. If you are single and your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If your combined income is above $34,000, up to 85% may be taxable. For married couples filing jointly, the thresholds are $32,000 and $44,000 respectively. Now, these thresholds have not been adjusted for inflation in decades, which means that more and more Social Security recipients are finding that their benefits are subject to taxation. This is something to factor into your retirement planning, and you might want to consult with a tax professional to develop strategies for minimizing the tax impact. Social Security provides benefits not just for disabled adults, but also for disabled children through the SSI program I mentioned earlier. And there is another benefit that many people do not know about. If you are receiving Social Security retirement or disability benefits, your minor children may be eligible for dependent benefits worth up to 50% of your benefit amount. These dependent benefits continue until the child turns 18 or up to age 19 if they are still in high school full-time. And if your child became disabled before age 22, they may be eligible for adult disabled child benefits that can continue for their entire life, even after you are gone. This is an incredibly valuable benefit for families dealing with the challenges of caring for a disabled child. And the current changes include adjustments to these benefit amounts as well. If you have a disabled child and you are not currently receiving these benefits, you need to contact the Social Security Administration right away because they do not automatically know about your child's disability unless you apply for benefits. The application process requires medical evidence and documentation, but it is absolutely worth the effort because these benefits can provide crucial financial support for your family. It affects the way the Social Security Administration processes applications and appeals. If you have applied for benefits and been denied, or if you disagree with the decision the Social Security Administration has made about your benefits, you have the right to appeal. The appeals process has several levels, starting with reconsideration, then a hearing before an administrative law judge, then review by the Appeals Council, and finally federal court if necessary. The Social Security Administration has been working to reduce the backlog of appeals and speed up the process, and they have implemented new procedures that are taking effect right now. If you are currently waiting for an appeal decision, these changes could mean you will get an answer sooner than you expected. Let me tell you about something that is absolutely critical for anyone who is planning to apply for Social Security benefits in the near future. The documents you will need to apply include proof of your age, typically your birth certificate, proof of U.S. citizenship or lawful immigration status, and your W-2 forms or self-employment tax returns for the most recent year. If you are applying for spousal benefits, you will need your marriage certificate. If you are applying as a divorced spouse, you will need your divorce decree. If you are applying for survivor benefits, you will need the death certificate of your deceased spouse. And if you are applying for disability benefits, you will need detailed medical records documenting your disability and how it prevents you from working. Start collecting them now, especially if you are planning to apply when you turn 62 or reach your full retirement age. The Social Security Administration accepts applications up to 4 months before you want your benefits to start, and I strongly recommend applying as early as possible to avoid any delays in receiving your first payment. You can apply online through the Social Security Administration's website, by phone, or by scheduling an appointment at your local Social Security office. The online application is usually the fastest and most convenient option, and it allows you to complete everything from the comfort of your own home. Now, I want to talk about something that gives a lot of people peace of mind, and that is the fact that Social Security benefits are protected in ways that many other types of income are not. Your Social Security benefits generally cannot be garnished by creditors if you owe debts. There are only a few exceptions to this rule. The federal government can garnish your benefits if you owe federal taxes, federal student loans, or if you are behind on child support or alimony payments. But credit card companies, medical providers, and other private creditors cannot touch your Social Security benefits. This protection is especially important for seniors who might be struggling with debt because it ensures that your basic income remains available to cover your essential living expenses. Let me share something with you that highlights why these changes matter so much. Over the past few years, inflation has been hitting seniors particularly hard. The cost of everything from food to housing to healthcare has skyrocketed, and people on fixed incomes have been squeezed tighter and tighter. The cost of living adjustment that is taking effect now is the government's response to that pressure. It is designed to help your Social Security benefits keep pace with rising costs so that your purchasing power does not erode over time. While no cost of living adjustment can completely offset inflation, especially when prices have risen as dramatically as they have recently, this increase is significant and will provide real relief for millions of Americans.